chapter that we are going to look is basically capital budgeting. Actually, this is an excerpt from another ours, but the finance book. It is chapter 11. So our today's learning topic for this particular given as capital budgeting problems. And then second one, explain why opportunity cost must be included in cash flows, while cost and interest expense must not. And then we're going to calculate taxes that must be paid, including tax loss carry forward and carrybacks. Last one, calculate cash flows for a given project. So basically what we have already learned in chapter and is on the techniques on the final part, on the evaluation part, but to derive to the numbers, we need to go through how to generate the free cash flows in the capital budgeting. So this is a chapter we are going to learn on that. And also we're going to go on the illustrate the impact of depreciation on cash flows and describe the appropriate selection of discount rate for a particular set of circumstances. Okay, let's look at the first one, which is give you some introduction on capital budgeting. Most of them are already recorded, so I'm just going to run through all of them here.
Let's look at the 7.1, which is forecasting earnings. Okay, as defined here, capital budget is the investment that a company plans to undertake, while a capital budgeting is a process used to analyze alternate investment and decide which one to accept. So basically, it's a process of forecasting for each project's future of the firm. So what we're going to do is that we are going to look at the revenues and costs. We're going to make projections on that, and we are going to, at the end of the day, we are going to figure out what is the free cash flows for each year of the lifespan of the project. And from there on, at the end of the day, we are going to figure out what is the NPV of this cash flow to assess and to make decisions whether we will be going ahead with the projects or not. So basically, we often need to rely on different experts or different operators from the firm. For example, marketing department will provide sales forecasts, and the operation managers will provide some information about the production costs, as well as the firm engineers will probably estimate some of the upfront research and also the development costs. So in particularly, practitioners will often base the assessment of project revenues and the costs using the information on revenues and costs that also we can derive from all those historical financial aspects and also from the competitors. So what we're going to do is that basically we are just making projection. The projection, as it says, can comes from all the divisions or departments in the company, and also be looked upon at the historical financial statement or the historical revenues, and just simply making the projection and see how is it going to be. So these are a combination of several factors, so that at the end of the day, it will be reanalyzed and be reiterated and see what is the possibility projected figures will be. We will also look at the definition of incremental earnings. It is defined as the amount by which the firm's earnings are expected to change as a result of the investment decision. So here what we are looking at is that we are looking at what are the additional impact of how the project would affect either the earnings or the costs, and we would like to see all the incremental effect, the additional effect of it. So what we are looking is that we are, at the end of the day, we are looking at before the project comes in and after the project comes in, what are the effects. So every time when we were to figure out what are the line items for each, whether it's revenues or costs, we are looking at the additional effect, in which we call it as the incremental earnings. So let's look at a company, okay, which is a capital budgeting decision faced by manager of a company called Linksys division of a Cisco system. And this hypothetical division is a maker of consumer network hardware. Linksys is considering of developing a wireless home network appliances. We call it as HomeNet. And it will then provide both the hardware and the software necessary to run an entire home from any internet connections. So in addition to connecting the PCs and printers, HomeNet will control new internet-capable stereos, digital video recorders, heating and air conditions, major appliances, telephone and security system, and also office equipment. For that, the company has conducted a 300,000 worth of feasibility study to assess the attractiveness of the new product. So it's like a smart home. Is used for a smart home where what you can do is that you so it's like a gadget, it's a smart control, and they are trying to sell it and package it to the market. So based on the marketing surveys, the sales forecast of this HomeNet kind of package or smart home type of package is the projected is going to be 100,000 units per year. So given the technology change, the pace of it, Linksys division expect that the product will have the most 4 years life, and it will be sold through the retail store, which is a high-end electronic stores for a retail price of around $375 with and they expected to sell it at a wholesale price of around $260. Let's look at other costs that is related to it. It's assumed that the industrial design teams will make the box and its packaging aesthetically so that it will be acceptable by the markets. Linksys expects engineering and design costs to be amounted to $5 million. Okay, so basically in order to design the whole remote control system, it seems that it costs them $5 million. Once the design is finalized, the actual production will be outsourced at a cost, including packaging at $100, $110 per unit. So it will be manufactured by other companies, and the cost to them to buy back from that company is $110. So in addition to the hardware cost, Linksys must also build a new software application to allow virtual control of the home from the web. The software development project requires coordination with each of the web appliance manufacturers, and it is expected to have a dedicated team of 450 software engineers in one full year. So the cost of hiring the engineers is around $200,000 per year. So in order to ensure the compatibility of the new consumer appliances with the HomeNet system, Linksys must also install new equipment that will require an upfront investment of $7.5 million. So it will be the cost of a new server in which new other appliances, other branded appliances, they are able to test whether the appliances will be compatible with Linksys by interfacing with the server and see the compatibility. So Linksys have to invest in buying the server. The software and hardware design will be completed and the new equipment will be operational and expected at the end of 1 year. At that time, HomeNet will be ready to ship Linksys. Expect to spend nearly 2.8 million per year on marketing and support of this product. So here, HomeNet also requires $7.5 million in equipment that will require and allow third-party manufacturers to upload the specification and verify the compatibility of any new internet-ready appliances that they might produce. So basically, it will have basically a server, and it allows to interfaces interact between third-party manufacturers of appliances to interact and see whether it's compatible with the HomeNet product. So to encourage the development of compatible products and provide services for existing consumers, Linksys expect to continue to operate this equipment even after they phase out the current version of the product. So basically what we're going to do is that we are going to apply a straight line depreciation, which the asset cost is divided equally over its estimated useful life. So we assume the equipment is purchased at the end of year 0 and then use a straight line depreciation over a 5-year life for the new equipment. Therefore, HomeNet depreciation expense per year will be 1.5 million per year in year 1 through year 5. Let's look at this. Once we get most of the data ready, we can generate a basic earning forecast. So we name it as HomeNet's incremental earnings forecast. If we were to look at this spreadsheet, what we talk of items. The items that we able to put on is the sales, the cost of goods sold, gross profit, selling general administrative costs, research development, depreciation, EBIT, earnings before interest and taxation, income tax at 40%, and then we have the unlevered net income. Unlevered meaning to say that basically the amount of money that was invested is used not from borrowing but from injection from the equity by issuing shares or by using the retained earnings. So basically here we call it unlevered net income, where we don't take into consideration the interest expense part here. There's no borrowing that is involved here. So we call it as unlevered net income. And also we can see that our projection figure starts from year 0, 1, 2, 3, 4, 5. So in order to get more detail on how all these aggregate figures were derived, let me take you into the Excel spreadsheet in detail. It's a snapshot of the Excel spreadsheet that will be attached, and it will be located at tab name base. Okay, if you were to look at this spreadsheet, is a similar one that from the previous one, except that I just would like to show you how this so in addition to the line items being described previously from sales to unlevered net income, there's new line items that's been developed, which are basically the units and the sale price per unit and the cost price per unit. So the assumption is that Linksys will sell HomeNet package 100,000 units per year for the next 4 years, and then the sales price that will be sold at $260 per unit, and the cost per unit is the outsource cost. They outsource it to another manufacturing company, and the cost of buying or purchasing back in a wholesale at the wholesale price is $110. So if you were to look at here, the aggregate sales price are derived, which is here is 1,000 here, but because one unit is equivalent to 1,000, so it's 26 million. But anyway, let's just assume that the number as it is. Let's say how the numbers were being derived. If you were to look at the formula here, it would say that it is basically derived from 100,000 per unit times $260 per unit, so you have basically 26 million. So as the cost of goods sold, how we get the cost of goods sold per unit, 100,000 times the cost per unit, you have the total cost of goods sold around 11 million. So as far as the gross profit for first year is going to be 26 million minus 11 million, you have 11 million. And then we have this called SG&A expenses. SG&A expenses, I've already mentioned that the Linksys company has decided to commit $22.8 million per year on the marketing cost that includes all the staff costs as well as other overhead costs, which is 26 million. And then as far as depreciation here, we assume that it is the server is going lifespan 7.5 billion. Okay, it says here, as you can see, the server is to allow third party to upload specification and verify compatibility of any internet-ready appliances. So the server, as it is, everything, the software and the hardware that is in the server will cost around $7.5 million. So, so then from there on, based on the straight line depreciation, in which we would just divide by 5 years. So each year, the depreciation cost will be 7.5 divided by 5, which is 1.5 million. So all in all, for our EBIT, it will be result from 15 million minus 2.8 million minus depreciation. We have 10.7 million, and net income 40%. So the unlevered net income is 60% of the EBIT. So we have 6240. So we assume the figures are the same for year 1 to year 4, except year 5. Year 5, since we have to include year 5 because we have to include the depreciation cost. But if you were to calculate it, we would have the unlevered net income as 900,000. As far as year 0, we have to include also the R&D costs, because here as far as the expenses are concerned, we are involved in the hardware costs of designing the whole package, and it costs it costs around $5 million. So the $5 million is basically the designing the remote package, the remote control. It seems that the cost to make it aesthetically nice, attractive, and everything, the hardware design cost is $5 million, as well as the software engineering cost. As we know that it requires around 50 engineers and hire 200,000 per engineer, so that the cost of the software engineering cost is 10 million plus 5 million. So in year 0, before it is being commercialized, being sold, all the research and development costs will be around 50 million. So, and then since there's no other cost in year 0, so what we have done is that we plus it, and our EBIT will be minus 15 million, and then we have to also income tax, which the losses, which is 40% times 50 million, so which is 6 million, and our unlevered net income for the year 0 is around 9 million. So all in all, what we can see is that the current cost of that year is year 0 is minus 9 million, year 1 is 6,420,000 until year 4, and year 5 is around 900,000. As we have already learned in chapter 4, which is free cash flows, when we were to consider the feasibility of a project when it comes to cash flow, we would not take into consideration the financing expense first during the initial stage. So what we are so in other words, what we are going to do is that we're going to ignore the interest expense because it has to do with financing expenses. So it says that in capital budgeting decision, interest expense is typically not included. The rationale is that the project should not be judged on its, it should be judged on its own, not on how it will be financed. For the corporate tax rate, the tax rate or marginal or incremental dollar of pre-tax income. So the way how we calculate the income tax is we take the earnings before interest and taxation times the tax rate. So if, let's say we've already calculated and the income tax comes out as a minus, let's say we calculated, if we were to come up the EBIT as a minus figure, and then we times the tax rate. So in other words, the income tax here, it becomes a tax credit in which the tax credit can be used to offset against any profit that the company actually made in the future. So in the nutshell, when we were to calculate at the bottom line, which we call it the unlevered net income, in which as I said again, net income, which doesn't take into consideration the finance expense, that is the interest expense, we consider it as the unlevered net income. So unlevered net income is basically the way how we are going to calculate it is EBIT times 1 minus T. I mean, basically that is what we have already learned in chapter 4. So if you were to expand the EBIT, it becomes revenue minus cost minus depreciation times 1 minus T. So that is, so we have to know from these, we are going to, later on, we are going to go step by step on how we're going to derive the free cash flow. So as I said, when we were to do any valuation, the most important thing is that we have to come up to the, at the end of the line item, which is free cash flow. We don't do any valuation based on the net income because it's based on the accounting perspective. So what we are going to do is that, again, we base on the finance perspective, which is based on the free cash flows. Let's look at the tax losses for projects in profitable companies. The Kellogg company plans to launch a new line of high-fiber, zero-trans-fat breakfast pastries. The heavy advertising expenses associated with the new product launch will generate operating losses of 15 million next year for the product. Kellogg expects to earn pre-tax income of 460 million from operation other than the new pastries next year. If Kellogg pays a 40% tax rate on its pre-tax income, what will it owe in taxes next year without the new pastry product? And then in the other question, what will it owe with the new pastries? So let's look at the explanation to it. Without the new pastries, Kellogg will owe 460 million times 40%, which is the tax rate is 144 million in corporate tax next year. But with the new pastries, Keelong's pre-tax income next year will be only 460 minus the losses, 15 million, which is 445 million. And it will owe 445 million times 40% tax, which is 178 million in tax. Therefore, launching the new product reduces Keelong taxes next year by 184 million minus 178 million minus 6 million. So what we are seeing here is that even though the company incur losses, but in terms of the tax saving, there's a tax saving of around 6 million on top of that. So in other words, basically the net losses there, which is basically 15 minus $6 million. Another example, PepsiCo Inc. plans to launch a new line of energy drinks. The marketing expenses associated with launching the new product will generate operating losses of 500 million next year for the product. Pepsi expects to earn pre-tax income of 7 billion from operations other than the new energy drinks next year. Pepsi pays 39% tax rate on its pre-tax income. Question will be more or less the same that we've been through in the previous slide. So what will Pepsi owe in taxes next year without the new energy drinks? And also what will it owe with the new energy drinks? Hence, without the new energy drinks, Pepsi will owe corporate taxes next year in the amount of 7 billion times 39%, which is $2.730 billion. But with the new energy drinks, Pepsi will owe corporate taxes next year in the amount of 6.5 billion, which is basically 7 billion minus its losses, minus 500 million. So you have 6.5 billion times 9%, which is 2.535 billion. So therefore, the launching of the new product reduces Pepsi taxes next year by 2.730 billion minus 0.535 billion, which is 195 million. So therefore, even though taxi losses of 500 million, but there's a tax savings of 195 million. Let's look at this term we call opportunity cost. Many projects use a resource that the company already owns. So is it free? Because the firm does not need to pay cash to acquire these resources for a new project, it is tempting to assume that the resources is available for free. So we assume that because we don't have to acquire elsewhere externally, so it's already available there, so we consider it's free. Is it right to consider it is free? So because this value is lost when the resource is used by another project, we should include the opportunity cost as an incremental cost of the project. So in other words, since we decided to use that resource, and that resource can actually be used for something else, and you are depriving for something else, so you have to take into consideration the fact that if that resource is being used for something else, you have to acquire externally. So you have to consider the cost of using that resource. So in the case of HomeNet project, suppose the project will require space for a new lab, even though the lab will be housed in existing facility, we must include the opportunity cost of not using the space in alternative use. So basically, there's a lab there, and it is not being used right now, but it can be used for something else. But Linksys decided to utilize the lab. So in other words, we have to the cost of the rental for the lab. So that is the opportunity cost. Let's look at one of the example. The opportunity cost of HomeNet's lab space. Suppose HomeNet's new lab will be housed in a warehouse space that the company would have otherwise rented out for 200,000 per year during year 1 to year 4. So which is every year it is going to be rented for 200,000. How does this opportunity cost affect HomeNet's incremental earnings? So in this case, the opportunity cost of the warehouse space is the foregone rent. This cost would reduce HomeNet's incremental earnings during the year from year 1 to year 4 by 200,000 times 1 minus 40%, which is 120,000, the after-tax benefit of renting out the warehouse space. So in other words, since HomeNet is going to use that space, so it has to be included in its costing. So the cost of it is going to be 200,000, and the after effect of it, after taking into consideration the tax impact, it will be only 120,000. We'll look at it in the following spreadsheet in which it is going to be included.
Okay, let's look at other indirect externalities. Project externalities, indirect effects of the project that may affect the profits of other business activities of the firm, which we call it cannibalization. Cannibalization is when sales of a new product displaces sales of existing product. Okay, let's look at the example here.
Therefore, suppose approximately 25% of HomeNet's sales come from customers who would have purchased an existing Linksys wireless router if HomeNet were not available. So, in other words, previously, Linksys division has also produced some sort of a wireless or smart remote box, but with HomeNet is considered the newer version. So you have the old and the new, which is HomeNet. So if this reduction in sales of the existing wireless router is a consequence of the decision to develop HomeNet, then we must include it when calculating HomeNet's incremental earnings. So in other words, we have to not only look at HomeNet profit as total, but we have to know how HomeNet affects its similar product in which is under the same roof of Linksys division. As a result, what we're going to show is the spreadsheet from the HomeNet's incremental earnings forecast, including cannibalization and the lost rent. So here is what is also being shown in the chapter 8. But anyway, in order for us to be able to understand how the numbers comes about, we have to dissect it and it should be shown, and it would be reflected in the following Excel spreadsheet. So let's turn to the cannibalization effect. So what we have here is based on the Excel spreadsheet under the tab.
About that.
So let's turn to the cannibalization effect. So what we have here is based on the Excel spreadsheet under the tab Cannibal. I've already developed the spreadsheet that resembles the one that is in the book. So if you were to look here, okay, you have the new units, and this is the old units of the wireless system. So as we already well aware that this is a HomeNet, and this one is the old types of wireless or remote control that been developed previously. So the number of units is the same 100,000 units, and assuming that previously it was being sold at the same number of units, but as a result of the introduction of the HomeNet, the old unit has lost 25% of it they used to sell. So basically, the way how it's been calculated here is that 25% times the number of units that they used to sell, which is 100,000. So you have 25,000. And as far as the sale price of the old unit here is used to be around at $100, whereas HomeNet currently is selling at $260, as well as the cost price for the old unit used to be around $60, which is they outsource it and bought it from third party. But as far as HomeNet is concerned, they are buying at $110. So from all these numbers, we can develop it and able to reflect in the new dollar amount. So if you were to look here, we'll also look at this part here where it says incremental. We are looking at the differences of between the sales of new unit less sales of the old unit. The effects that we have to look holistically in terms of the marginal effect or incremental effect. Even though we managed to sell the new units, but since the old unit, we are taking away from it, so we have to take that into consideration. So the numbers that we developed here is, as far as HomeNet is concerned, is the sales unit is 26 million. Okay, so the 26 million is basically developed from 100,000 times 260, you get 26 million. But for the sales of old unit that has been cannibalized, we also have to take that into consideration. So the numbers that we got here is from the 25,000 units that is being cannibalized times the sale price of the old unit, which is $100. So the effect of it we are losing is taken away around 2.5 million. So the net impact on sale is around 23.5 million. Same with the cost of goods sold. For the cost of goods sold for the HomeNet is basically what we can gather here is we get it from here, which is 11 million. The 11 million derives from 100,000 times $110 per unit cost, which is 11 million. And for the old unit here, basically it's $25,000. We are using around 5 million. So overall, we can redevelop into a new, this is a new area where we summarize the whole impact of the sales and the cost of goods sold. So the 23 million is derived from this figure here, the net impact of it from the cannibalization effect, 23.5 million, whereas the cost of goods sold is from also the net cost is derived from here, which is 9.5 million. So all in all, what we have here is that we have the gross profit, which is 14.8 million. The rest more or less the same. The SG&A expenses is 2.8 million here. As we already knew, that is for the marketing costs, and for the opportunity costs that which is the rental costs that we are not renting out the space. That in fact what we did was that we decided to use it for the production, and the same amount which is R&D is still there, 50 million, which is the cost for developing the new remote system, which is the hardware cost plus the software cost, all in all becomes 50 million. For the depreciation is still there. And once we tabulate the new figures there, we have 9.5 million, and for the EBIT, and for the income tax, which is 40%, and the unlevered net income is 5.7 million. So the numbers is the same for year 1 to year 4, except year 5, because we don't have any figures here. We only have to take into consideration only the depreciation impact. Here is basically a tax credit, so the unlevered net income losses here is only 900,000 rather than $1.5 million. For the year 0, it's the same. The unlevered net income is 9 million. Sunk costs. A sunk cost is any unrecoverable cost from which the firm is already liable. Some costs have been or will be paid regardless of the decision about whether or not to proceed with the project. Therefore, they are not incremental with respect to the current decision and should not be included in the analysis. For this reason, we do not include in our analysis. So even though it's an expense that we already incurred, but in terms of the relevancy of in the analysis is not being considered. So it is a sunk cost as opposed to the opportunity cost. So for example, a fixed overhead expense can be considered as a sunk cost. Overhead expenses are basically associated with activities that are not directly associated to a single business activity, but instead it affects many other different areas of the company. These expenses are often allocated to different business activities for accounting purpose, to the extent that these overhead costs are fixed and will be not incurred. In any case, they are not incremental to the project and should not be included. Only include incremental expenses, the additional overhead expenses that arise. So basically what we have is that, let's say, a fixed cost that for example a machine or server or plant or equipment that serve so many projects, and then you like to see whether if you were to include additional project and the fixed asset or the machine serve that particular project, does it have any effect? In other words, having the equipment or machine serving so many projects, evaluating which project is relevant or not, it doesn't serve any purpose because everybody incurring the same expenses. The other way that can be included as a sunk cost is, let's say, a past research and development expenditure. So when a firm has already devoted significant resources to develop a new product, there may be a tendency to continue investing in the product even though the market conditions have changed and it becomes less viable to continue with producing the product. The rationale sometimes given is that if the product is abandoned, then the money has already been invested will be wasted. In other words, a decision is made to abandon a project because it cannot possibly be successful enough to recoup the investment that has already been made. In fact, neither argument is correct. Any money that has already been spent is a sunk cost, and therefore that is relevant. So in other words, if you find that the project is not producing any profit, and if you were to continue it further, it will generate a losses. So basically that losses, that expenses is already considered a sunk cost, and that means to say it is not viable to continue and the project is abandoned. So the decision to continue or abandon should base only on incremental costs and benefits of the product going forward. So in other words, if the company were to pursue a new projects, so the last projects and losses that they already incurred, it should be irrelevant in evaluating or assessing the new projects, because the new project has no linkage with the old project. So the old project, the losses that it has incurred is irrelevant. With assessing whether to go ahead with new projects. Before that, HomeNet example is focused on simplifying. But in a real project, however, the estimates of these revenues and costs are likely to be much more complicated. For example, the assumption that the same number of HomeNets will be sold each year is probably not realistic enough. A new project typically has lower sales initially as customers gradually become aware of the product. Sales will then accelerate, peaked, and then ultimately declined as the product nears obsolescence or face increased competition. So similarly, in terms of the costs, will be the same. So the average selling price of a product and its cost of production will generally change over time. Prices and costs tend to rise when the general level of inflation of the economy. But the prices of technology products, however, often fall over time as newer, superior technologies emerge and production costs declined. For most industries, competitions tend to reduce profit margin over time. So these are the kind of factors that need to be considered when estimating projects. So you have to look at also the seasonality effect, the competition effect, and so how's the trend of most of the previous products that has been rolled out previously. Let's look at one of the example, 8.3, product adoption and price changes. Suppose sales of HomeNet were expected 100,000 units in year 1, 125,000 in year 2 and 3, and 50,000 units in year 4. Suppose also that HomeNet's sale price and manufacturing costs are expected to decline by 10% per year as with other networking products. By contrast, selling, general and administrative expenses are expected to rise with inflation by 4% per year. Update the incremental forecasts in the spreadsheet in table 8.2 to account for these changes. If you were to look at the example 8.3, we will find that the sales figure has kind of fluctuated. It's not evenly distributed from year 1 to year 4. And as a result, the unlevered net income has also changed except year 0 and year 5. And therefore year 1 and 4 changes because of our assumptions that sales increase changes. So let's go in detail in the following slide. Let's revisit the Excel spreadsheet under the tab Real. So what we have here is that we already see the previous one, we already done a look into the cannibalization effect, the new and the old one. And then if we were to go further downwards, okay, here is where the assumption changes in terms of the sale effect, the units effect. So the units has changed. For year 1 is the same except year 2, year 3 has increased 125,000, year 4 has decreased to 50,000. So as a result, all the numbers, subsequent numbers also affected. Same with the we assume that the way how the trend goes about is following the effect of the old wireless system. So here the cannibalization effect in terms of unit also change. So we can see that the numbers here is 25,000 is basically from 100,000, the 31,000, which is 25% of the 125,000 for the new figure. So as year 3 and year 4. As far as the rest here, is also changed. The sales price has decreased to 60, and here it decreased by 10%, and for year 3 it has also decreased by 10%, and year 4 also decreased, okay, from the previous year. So there's a decrease of 10%. So here, if you were to look at here again, it is affected the same thing for the all units. So it's 10% decrease in year 2 from the year 1 of $100, so it decreased by 10%. Year 3 also decreased, and year 4 also decreased. So as with the cost of goods sold, if you were to look, it decreased by 10% for the old unit. For the new unit, for the old unit is also decreased by 10%. So the net effect of everything here for the sales of the new unit, so what we have here is that sales is basically 100,000 times 260, the same for year 1. But let's look at the year 2. Year 2, it has somehow increased. The number of units increased, but the price sales per unit has decreased. But in terms of aggregate, it has increased from year 1, which is 29 million versus 26 million the previous year. For the third year, it's the same, but the fourth year is totally decreased. And we can see the effect for the all units at the same time. So the all units are basically 25 million times 25,000 times $100, so you get around 2.5 million for year 2. You can see the effect here, because this one depending from the previous one, which is basically 25% times the G620. So this is 25% of 125,000, so that 31,250 times the sales of the old price, which has decreased 10%. But in terms of aggregate wise compared to the last year, it has increased. So the net sale impact here for year 1 is 23.5 million, for year 2 is 26 million. So you can see there's an increase in year 3 and 4. Year 4 also has decreased, okay, from year 2, and year 4 is also much decreased. So all in all the effects here, it affects basically affects all the gross profit. All the numbers trickle down to the sales and cost of goods sold. So it's going to affect on the gross profit 50,000,075 for the second year, 14.17 for the third year, whereas for the fourth year is 5.1 million. And if you were to look at all the numbers here, these numbers are the same, these numbers are the same, these numbers are the same. So the tax is still 40% of the EBIT. So we have a new figure for the year 1 to year 4. So we can see the numbers as this is the basic numbers we calculated previously, and then the unlevered net income increased, and then it decreased, and then it decreased furthermore on the fourth year.
Let's look at determining free cash flow, the incremental effect of a project on a firm's available cash is a free cash flow. So when we have already gone through is on the until the net income. So we're going to extend our analysis into finding the free cash flow.
Determining free cash flow and calculating free cash flows from earning. There are important differences between earnings and cash flow. Earnings include non-cash charges such as depreciation. However, they do not include the cost of capital investment. That means to say the machines, how much you buy the machines initially. So to determine HomeNet's free cash flow from its incremental earnings, we need to make some adjustments. So let's look at the capital expenditure and depreciation. So depreciation is not a cash expense that is paid by the firm. Rather, it is a method used for accounting and tax purpose to allocate the original purchase cost of the asset over its life, because depreciation is not a cash flow. Therefore, we do not include in the cash flow forecast. We have to take it up. We have to ensure that we only take into consideration only the cash aspect. Instead, we include the actual cash cost of the asset when it is being purchased. Let us refer to back to the example 8.2, in which we extract the figure on the cannibalization when the sales are relatively on the cannibalization, and the unlevered net income is year 0 is minus 9,000, and then it goes to 5,700, 5,700, 5,700, and you have thousand. Again, it's based on what we another line, which is from the unlevered net income, we add the plus depreciation, and then we minus the less capital expenditure and less net working capital. As we know that initially what we did was when we were to figure out the income, we add the depreciation, and then we minus the income tax. And then when we have already done with the income, we have to add back depreciation, because here the depreciation, as we know, based on the free cash flow, depreciation is a non-cash item. And therefore, once we've done with the tax again, as mentioned, we have to add back the non-cash item to reflect back the actual cash. Then we less the capital expenditure. That means to say we have to figure out how much we spend the capital expenditure for that particular year, and then we minus the net working capital. As we know, we'll learn later on, net working capital is the changes in the current asset minus the changes in the current liability. Only then, once we've already done with these two, we are going to be able to figure out the free cash flow. The details I'm going to look in. We are going to go through the Excel spreadsheet later on. Let's figure out how to find the net working capital. Okay, this is based on what we've already again learned in chapter 4, which is net working capital is basically is current asset minus current liability. So we know that the component of current asset is cash plus inventory plus receivables, and the current liability is payables. So most projects will require investment in net working capital, and before you were to start any projects, you need to finance, you need to have funding for inventories and receivables. So you need to allocate some funding. It's a opportunity cost, because it is something that the investment that you can use funds elsewhere, but you have to reallocate it for inventories and receivables. But some of these you can finance it by borrowing through short-term borrowing, which is a payable. So you minus your payables. So what you wanted to know is the net, not the gross working capital. You figure out the net working capital. So in other words, it says here trade credit is the difference between receivables and payables. So in a nutshell, what you wanted to figure out is the increase in the net working capital. So here you like to see the changes in the net working capital, which is the difference between the current net working capital minus the net working capital in the previous year. we are not going to get the absolute figure because, for example, cash inventory receivables, you tend to use every year. You tend to use within every year, meaning to say that when you use your receivables, when you allocate the receivables at the end of 45 days, you are going to collect it from your customers, and then you are able to receive this. Then you can recycle the amount that you receive from your customers, and then you can reallocate to new customers. So it's like a rolling figure. So what you need to know is that what are the changes, if there are any increase in reallocation of receivables from year to year. So there's a reason why you're looking at the net working capital. Same with any increase in inventories and cash and payables. So the end of the day, you're looking at the changes, not the figure itself on the year to year. What's the absolute figure in year one, year two? But you are looking at the changes between the difference between year two and year one, or year three and year two. For HomeNet working capital, we know that HomeNet outsource the manufacturing of the smart remote control to another manufacturing company, so they don't have any inventories, assuming they don't keep any cash, and they only owe short-term wise to the third party for manufacturing their products. So they have receivables, which is the way how it's been calculated is 15% of the sales amount, and they also have they owe to other third parties in terms of payables, assuming that is, or to the suppliers, which is 50% of the cost of goods sold. So if based on these assumptions here, we can figure out what we're going to do is that we're going to take 15% of the figures that we have in sales, okay, for each one of them. So we have, those are the amounts. And for the payables, we take it against cost of goods sold, which is 50%. So we have that amount. So as we know that working capital, net working capital is receivables minus payables. So you minus each of those amount here. So 3525 minus 1425, you have 2100, 2100, 2100, and 2100. And we are not going to take the net working capital as it is. We are going to minus, see the changes from year one to year two. So the net effect we're going to see later on, that we are going to look at the changes in the working capital, is that the changes in the working capital for year one is around 2100, and for year two is going to be 0, 0, and so on and so forth. We are going to show it later on. Let us look at again at the table 8.2 in Excel under the tab cannibalization. So as we know that the top part there, we have the new remote control, which is the HomeNet, and you have the old ones. Okay. And then if you were to move, we've already figured out the incremental effect here, and then from there on, we've already figured out what is the unlevered net income. So there's the part here. And then as I mentioned, based on, in order to figure out the free cash flow, we have to plus the depreciation. So we add back the depreciation amount, which is the same figure that we have on top there. We plus the depreciation, and then we minus the capital expenditure. But it seems the capital expenditure here is which is 7.5 million, in which we bought it in the year 0. So other years we don't have because it is a one-time payment. So we bought it at year 0, 7.5 million. And for the increase in the net working capital based on the previous slide, okay, the slide before this, we've already figured out the increase in the net working capital is 0, 2,100, 2,100, 2,100, 2,100, and 0 period here. So, but then what we are interested is the changes. So what we did was that we take year 1 versus year 0, year 2 versus minus year 1, year 3 minus year 2, year 4 minus year 3, and year 5 minus year 4. So as a result, when we minus the years, so year 1 we have 2,100 minus year 0 is nothing, so we get 2,100. But then in year 2 we have 2,100 minus 2,100, so we zeroize it. So we got for year 2, 3, and 4, all of them are zeros. But in year 5, when we to figure out the changes, so what we did was that we take 0 minus 2,000 and 2,100, so you get minus 2,100. So meaning to say that at the end of the lifetime of that product, we are going to be able to recover back the account receivables. So because this is actually the amount of money we are able to recover, because here it says minus, and since this is also minus, basically we are recovering. So these are, since this is a positive, but here we minus it out. So these are the allocation of funds. We have to allocate we expect that we have account receivables is going to eat up 2,100 for our short-term funding. We have to reallocate 2,100. At the end of the 5th year, we are going to recover it back. So all in all, what we are seeing here is that if you were to look, let's say in year 1, what is the free cash flow? So you get 5,700 plus 1,500 minus 2,100, you get 5,100. So there's same with for the year 2. So we see that 5,700 plus 1,500, since there is 0, so the numbers is increase, and at the end for the year 5, what we are seeing is that we have minus here, minus 900,000 plus 1,500, and then we minus 2,100. So this is actually becomes a plus because you minus 2,100. So minus 900, you have plus 1,500 minus 2,100. So at the end of the day, you get an increase by 2,700.
So basically what you can do is you can just refer to the formula there and can see how the changes because then once you have a look at the cells, then you can know much better what it meant by that.
If you were to expand from table 8.3, which is slide number 30, okay, and if you were to figure out or derive the net working capital, we can see that in that scenario, we can see that the sales and the cost of goods sold change to reflect the realistic condition or situation in terms of the actual sales. Sales doesn't remain stagnant from year to year. So you can see there's an increase in sales, and also the cost of goods sold from year 1, it peaks to year 2 and year 3, and then it tends to declines 4. So if we were to extract that part there, which is table 8.3, and to figure out the working capital, assuming more or less the assumptions are the same as we did from table 8.2, the receivables are 15% of sales, the payables are 15% of cost of goods sold. So basically, those numbers are the percentages against the respective line items, and then we figure out what is the net working capital, which is 3525 minus 1425. So we have 2100. Same with year 2, 3966 minus 1603, we have 2363. So what we're going to find out is the changes in the working capital. So we figure out what is the incremental increase here. For year 1 is 2100 minus 0, you have 2100 here. For year 2, you have 2363 minus 2100, you have 263. And for year 3 changes, 2126 minus 2363. So we have a decrease here by 237. For year 4, we have 765 minus 2126, we have minus 1361, and finally 0 minus 765. So we have 765. So in this case, working capital changes each year. A large initial investment in working capital is required in year 1. Here, year 1, followed by small investment. Year 2, as sales continue to grow. Working capital is recovered in year 3 and year 4 as sales decline. As sales decline, so basically, most of the initial huge investment in working capital in year 1 and year 2 are being recovered back in year 3 and year 4. If you were to turn to the Excel spreadsheet under the tab rail, okay, if you were to actually look the whole changes and the effect on the free cash flow with the net working capital, okay, here's the part here where we try to figure out what are the units of and sales price per sales per unit and cost per unit. So here is the same as what we normally do in our spreadsheet. We have the new versus the old ones, and then from those figures there, then we derive the incremental effect here, that is the in terms of the net changes in the sales and the cost of goods sold based on year, and those numbers are going to fed it to the summarized figure on the sales and the cost of goods sold. And for the realistic changes scenario on the figures, we have the unlevered net income. Those are the amount, which is 9,000, 5,700. We have 6, 7, 8, and we have 6, 5, 6, 7, 5, 8, 1, 3, 7, and minus 900. And then here is where we find our depreciation. The same figure on the depreciation from year 1 to year 5. The capital expenditure is on the servers, which is the same. And if you were to look at the changes in the net working capital, those are the numbers that we've already worked on the previous slide, which is 2,100, 263. So we can see that as year 3 and year 4, we are able to recover back the working capital, or the working capital amount that we've already invested, especially on the account receivables. And then we have, so the effect of it, we have the free cash flow. So those numbers are basically are from net income plus depreciation minus the net working capital. Same with the year 3 and year 4 when we have the minus figure here. So the minus figure here is basically 137 plus depreciation minus, since this is minus, we have a double minus, so it becomes a plus. So we have plus 1361, 137 plus depreciation, and here we ended up plus the 1361, so we have 2998.